their customers went crazy because this was saving the hedge funds. Then the price of all these things started to go down. Within a week, GameStop lost almost 90% of its value. So this kind of, who knows how much higher it could have gone. There would have been a limit, but they kind of cut the rally short. Maybe it would have been worth $200 billion. Who knows, right?
My guest today is Spencer Jakab. Spencer is an award-winning investing columnist. He writes for and edits the Heard on the Street column at the Wall Street Journal and has previously written for the Financial Times and Dow Jones Newswires. His latest book, The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. During one crazy week in January 2021, retail traders at Reddit's Wall Street Bets forum had seemingly done the impossible. They had brought some of the biggest, richest players on Wall Street to their knees. I recently sat down with Spencer and we talked about how the meme stock squeeze unfolded and who were the architects and winners of the GameStop rally. Spencer, thanks so much for coming on the show. I greatly appreciate it. I've been looking forward to it.
Hey, thanks for having me, Charles.
Okay, so Spencer, the name of the book here, let me get the name of the book out of the way first because there's so much I want to talk to you about. It's The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. Boy, oh boy, this sounds like a counterintuitive book title. I read the book, and I know you know from what you speak. So let's get right to it. Last year, at around this time, we went through what was many called a revolution. The small investor taking on Wall Street, squeezing the shorts till they couldn't breathe, and almost took down Melvin Capital, which we'll get to in a second. But your book starts off with the revolution that wasn't. This wasn't anything that changed Wall Street at all. So, Spencer, look, man, you are an accomplished guy, Heard on the Street columnist at the Wall Street Journal. You are totally in touch with what's going on. What is everyone missing?
What everyone's missing is that Wall Street is a really big place. Let's think about it this way. Let's think about it in terms of gambling, right? Let's say that you and a bunch of friends were really good card counters, and you went to Las Vegas and you figured out how to beat the casino, how to beat the house. And you went to a couple of big casinos and you took them for tens of millions of dollars. Not illegal, and not illegal what these people did either, but something that the casinos frown upon, right? And you walked away, and then people found out about it, and it was a huge, huge deal. Maybe there are 20 casinos on the Strip, and two of them would have had a really bad week, really bad month, maybe even a really bad year. Let's say you really took them for a lot of money. What would you have? You'd have a bunch of other people, less talented than you, showing up, trying to do the same thing, and probably failing, and paying a lot of money to the casinos where they played. You'd have all those people spending money on taxis, on hotels, tipping the maid, tipping the bartender, going to restaurants. All the people who were the middlemen in Las Vegas wouldn't have been hurt by what you did, and they would have been helped a lot because a lot more chumps are showing up to play in the casino. And it's not a perfect analogy, but it's a decent analogy for what happened. So you had this handful of people who did very, very well. You had some thousands of people who did well, and then you had many thousands of people who actually wound up losing money. But the overall effect of it was a very good month on Wall Street, because Wall Street is a big place, primarily comprised of middlemen, of brokers, of market makers, of other hedge funds that took the right side of this, of investment banks that love it when there's volatility. And if you look up and down Wall Street, with a few exceptions, like Melvin Capital, which we'll get into, people did quite well. So it wasn't, it was a black eye for a couple of guys on Wall Street, not for all of Wall Street. And as I explained in the book, this new group of people that got into Wall Street, it was all gravy for Wall Street, because these are people who are not usually there. It's people with a lot less money, a lot less experience, a lot younger, people that 20 years ago never could have afforded to be on Wall Street because the technology and the pricing structure was just not right for them. And they came out in droves, and they mainly lost money, again, with some exceptions, and Wall Street is loving it.
Right. Okay, let's take a step back and let's start from the beginning, because what I like what your book does is living through this last year. I remember everyone was setting this up as David versus Goliath, smacking down the hedge funds, uh, HODL, diamond hands, all of that stuff that I was talking about. And um, what people didn't get at the time, and I think your book really captures, is the psychology that was playing on the players, on the media, and how a frenzy started to develop with all the psychological triggers, such as social proof, such as posting, with posting your E-Trade account or whatever it was up there. So let's take us back to the point of where the book almost starts, where the checks are going out, stimulus checks are going out to people who have young 20-some-odd-year-old people who are getting paid not to work, not to do anything, and we start right from there. Go ahead.
Yeah, I mean, it's a fascinating story because so many things had to happen, and that's a very important piece of it. Without the pandemic, this wouldn't have happened. Without the way the government reacted to the pandemic, this wouldn't have happened. And if you want to go back really far, without the global financial crisis in 2008 and 2009, this wouldn't have happened. So you have a generation whose formative financial experience is their parents struggling, maybe losing their homes, maybe losing their jobs, certainly losing a chunk of their investment portfolios if they had one. And they were pretty bitter about Wall Street's role in that. And the popular narrative is that Wall Street did it and got away scot-free, actually got off, making a lot more money because all the stimulus following the financial crisis has increased wealth inequality, has made people in private equity and investment banking, what have you, very wealthy. Obviously, it's not all the same people, and some people did fare poorly, but there were no major prosecutions. There were not a lot of crimes. There weren't people legally raked over the coals for a variety of complicated reasons. And so they feel like there's two sets of rules. Then you have, in 2018, you have sports betting legalized in most states. Before that, it was only possible in Vegas. Not to dwell on
Right.
Las Vegas too much in this story, but you had all these young men mostly playing daily fantasy sports. All of a sudden, on their phone, had these apps to gamble, and they were really, really into it. And lots of them got into it. And I have three sons. I have two of them are young men in this cohort. They don't do it, but their friends all do, or all seemingly all do. And then they started trading stocks because there are these free stock trading apps. They weren't really too interested in stocks yet. Here and there, some people were. But then in late 2019, Robinhood, which had gained about half of the new retail brokerage accounts in the US, basically everyone just kind of threw in the towel and said, okay, we'll make it free too. And they thought that it would be terrible for business. You're cutting the product of what you sell to zero. How could it not be bad for business? Of course, they had other ways of making money. And what they didn't realize, and what they should have understood, is that cutting commissions to zero actually led to an explosion in business. Because for this young generation especially, trading stocks is fun. It's a game. And when you take something that's fun and you make it free, then they rush out and they do it.
And you give them capital to do it. So you had a confluence.
Well, early in the pandemic, you gave them capital, or they gave themselves, right? There maybe there's somebody who still had their job, right? I don't want to say everyone was spending their stimmy checks, although a lot of people were, and they outright stated they were, or their unemployment benefits or whatever. But a lot of people just, if you're 23 years old, my oldest boy is, you get your money and you spend it right away. You don't save too much of it, right? And so all of a sudden, you can't go out on Friday night. You can't go out and go to McDonald's or whatever. And you're at home because there's a pandemic. You're bored. You're at mom and dad's house. Oh, hey, well, there's no sports to bet on either, except for Korean baseball, right? That was the only thing on. Remember that?
Yeah, but what's amazing is that the way I liked the way you laid it out was, you couldn't write a better script for this to happen. Everything lined up. The gamification of trading, the zero commissions, Robinhood, stimulus checks, the shutdown of any competition for young people's money for action, gambling. Like, oh my gosh, what'd you expect?
Right.
Something was going to happen. We didn't know how this became this, and you'll share with us how. But it had all the seeds for its own disaster.
And you had more than 10 million accounts open during this time.
Amazing.
That's a huge number of
Amazing.
accounts to open. And this is a generation that really is not too interested in finance and investing, right? A lot of young people, even places where I've worked, you talk to some young people are like, oh, you're putting money away in your 401k. No, I'll get to it. Like, it's free money, right? Like the company matches, and like it sort of, even you tell them that, like there are a lot of young people who just sort of, it's just a boring, dumb thing to them, right? All of a sudden, investing was this cool, fun thing that everybody was talking about. And then the final ingredient that set the stage for this is social media. Oh, sorry, the next to final ingredient, because social media today is not like the Yahoo Finance message boards that we remember from 25 years ago. Social media is much more potent in terms of getting you to do things and holding your attention because of the algorithmic nature of social media. It's because the messages, the people you're likely to follow and the messages you're likely to see, and especially on Reddit, which was the epicenter of this, are likely to be very reckless, very crazy and reckless, because who are you going to pay attention to? Charles, if you go on Reddit right now, I don't know if you have an account, but you can start an account and anybody's post can go viral on Reddit. It's not like being on Facebook or Twitter where you have to have a follower. And you can say something sober like, I think that this is a really good stock. I put 5% of my whole portfolio into it for A, B, C, D reason, right? And be very cerebral. You are not going to get any attention at all. I'm sorry to tell you, Charles. You might get it with our age cohort, but not with that age cohort and not on social media. Then let's say I go on there and I say, hey, I mortgaged my house and I bought deep out of the money call options on this one stock and I'm making a gigantic bet on it. And here's a screenshot of my account. I'm going to get a lot of attention. And now a third person comes to that site and is new to investing and says, well, I'm of the generation that gets its advice on how to do things from social media. They're not even going to see your post. It's not that they're not going to consider your post, which they might not, because you're being cerebral and boring. They're not even going to see it because it's not going to get upvoted. So they're only going to see my post and things like that. So the whole idea that they get for how to invest, especially on Wall Street Bets, which was the epicenter of this meme stock revolution, were pretty reckless, crazy things. So that sets the stage too. And then the last thing is what was going on in the stock market. The stock market had its most rapid, by far, descent from an all-time high to a bear market ever when the pandemic set in.
That was March
and then it had
March of 2020, right?
Right, exactly. And then it had its most rapid recovery into a new bull market ever by an order of magnitude. So if you're new to the stock market in March or April 2020, as so many young people were, anything you bought went up. You had to be really unlucky not to buy something that went up. 96% of stocks from that pandemic bottom in the following year rose, which is unprecedented. So, they say success is the worst teacher. Well, it was a really bad teacher in this case because basically everyone felt like they were a genius. And then all of a sudden there are all these new financial influencers, finfluencers, they call them, on social media who are telling people what to do. People with like 2 months or 3 months of trading experience are out there saying, this is how you make money. This is what I bought. This is what you need to do. And they had like 200,000 subscribers. So, and the funniest, craziest ones were the ones that took off the most. It wasn't that like I have a long track record. As a matter of fact, having a short track record was like a real badge of honor. There's this guy, Davey Day Trader Portnoy, who said, I've traded 1 or 2 stocks in my life ever. And then he set up a Twitter live feed to his over 2 million Twitter followers. And you know how he picked stocks? He'd pick out tiles from a Scrabble bag and people would go out and buy them.
Yeah.
So, I mean,
and he pissed on Warren Buffett. So,
right, exactly. Exactly. So I'm the captain now. Warren
Yeah.
Buffett, I'm sure he's a good guy, but I'm the captain now. So, I mean, it was kind of funny, but kind of sad. And so that set the stage for the amazing events of January 2021.
Right. Okay. Now, before we get there, I want to add one more thing. And you touched on it before, is there had to be a villain. And the villain was already there. You're looking at a cohort that 13 or 14 years ago saw their family struggle during the financial crisis of 2008, might have lost their homes, just really, really terrible things during 2006 to 2009, maybe even evicted, all of that. And there had to be someone to blame. So you had the villain, you had the means, you had the story, you had everything to make this happen.
Yeah. And who's going to be the villain, right? Because there are a lot of people on Wall Street. You're not going to find Angela Mozillo out there to blame. Not that name necessarily would mean anything to a 24-year-old on the internet today. But it was a guy on Wall Street who makes a lot of money, who wears a suit, and especially who sells stock short. And what stock do they sell short? They're selling stock short in a company, and they conflate selling a stock short with wanting to destroy a company, which is not the same thing. And I can explain. I know you have a sophisticated audience, but I can explain the nature of short selling.
Before you do that, when I was interviewed last year on several podcasts and TV shows or cable shows, they kept saying short selling destroys companies. I said, no, it doesn't. It does not.
No, it doesn't. No.
It's like talking apples and oranges. But the reflexive response was short selling is anti-American and puts companies out of business and puts people on the unemployment line. And I spent, like you're going to spend in just a few moments, explaining how the two have nothing to do with each other, and that that's what it comes out to. What I kept seeing, and especially your book points out with all the social proof and the influence, is that you needed a villain that everyone could agree upon, so much so that the media picked up on it, that the shorts were the enemy.
Mm-hmm. Yeah. I mean, anyone listening to this, if you want to see something fun, just pause the podcast for a minute, come back, and type into Google short sellers are and see what comes up. Okay. They are reviled, and they have been reviled for centuries. So since stock markets have existed, short selling has existed. It happens to be a vital part of well-functioning financial markets. But they have been, they've been flogged, they've been jailed, they've been called carrion and vermin and vultures. And why? Because they do the opposite of what 99% of us do. We buy a stock and we hope it goes up. They sell a stock and hope it goes down without owning it. Now, you really got to pick your spots as a short seller because you are open to unlimited losses. It's the opposite of us. You can make an infinite amount on any stock you buy. You could only lose the money you invested. Not going to come for your house after you lost all your money on Enron. You just lost your money, right? A short seller if you shorted Enron, you made 100% because it went to zero. And
that's your max gain.
You could lose
that's your maximum gain, right? Your maximum gain
that's your maximum gain.
If you short something at $10, the best it can do is go to zero. You short it at $100, the best it can go to zero. So the other side, what you're saying is that the trade can go against you to infinity. There's no limit to how so. So it's a asymmetrical bet where there's a minimum upside, and a unlimited downside, which makes it such a risky venture, which is only best left to people who know what they're doing and who have ample capital.
Yeah, do not try this at home, kids.
Nope.
But if you think about short sellers, people who are really betting against a stock, and this happens all the time. The story that I tell in my book is a crazy, unprecedented story, but short squeezes are a pretty routine event on Wall Street, just plain vanilla run-of-the-mill short squeezes, which is, it's like analogous to a bunch of people being in a theater and someone drops a cigarette on the carpet and then there's smoke and then they all rush for the exit and there's one exit door and a few people get trampled on the way out. Okay. This story is like the theater being packed to capacity. There's someone sitting in everybody's lap because there's so many bets against these loser companies that were involved. And then not only did the theater catch on fire, but there were some people who poured gasoline on it and then threw dynamite into the theater and then threw nitroglycerin on top of the dynamite. And they tried to create an absolute panic, and they did. And so the collective action of all these short sellers was off the charts. And that was, not only did they do it to make money, but they did it expressly to hurt the short sellers. And they did. There were some people who got hurt. They
went to destroy. They were on a mission to destroy these people. And they called people out like Melvin Capital, Gabe Plotnick, and you know. But you just back up for 1 second for our audience. As you were mentioning, Spencer, the short selling and squeezes where the stock starts to rise and the short sellers have to cover are as old as Wall Street. The most famous one, which was the biggest one until Reddit, was, I think it was the Northern Railroad, Northern Pacific
Yep.
Railroad, right?
Yeah.
1901, that pitted Jacob Schiff and against J.P. Morgan, syndicate against syndicate, and I think this thing went to started off at $150, and went up to $1,000. Just people were jumping off out of windows. It was just there were no shares to borrow. There were no shares to cover.
And that era is a fascinating era. I mean, I love financial history, but that's when I saw what was about to happen to GameStop, I thought of that era, because
100%.
up until the 1930s, this kind of stuff happened. I mean, to more or less extent, that's why people didn't trust the stock market as a place to invest money. It's because it was really just a plaything of people with a lot of money who were trying to mess each other up and doing things that many of which would be illegal today. And so when securities laws were passed, for example, it became illegal to, let's say, 2 or 3 rich guys or big funds see that a fourth guy is heavily short a stock. And they say, hey, let's get him. Let's quietly buy up all the stock and then show up. And then there won't be enough stock for him to cover his position. And then he has to pay us every last penny he has. We'll bankrupt him. You can't, that's a corner, and you can't do that anymore. But the law says you can't collude in secret to do it. It doesn't say that you can't get together out in the open on a social network and do it, and a social network that these Wall Street guys happen not to be paying any attention to because they think it's a joke and full of funny memes. And so you go back into this message board, and they were planning this thing out, and they knew, and there are some sophisticated people there who knew exactly the best way to do it.
Using options, using leverage, using a whole bunch of tricks, not tricks, but financial instruments in order to maximize the magnitude of the move.
Yeah, which is why it's like card counting, not illegal, but it's obviously the casino usually figures it out pretty quickly. But they did not figure this out until it was too late that it was happening. They did not take it seriously.
Okay.
They didn't see it coming. Some of them saw their names mentioned, but just thought it was a joke.
Right.
And they weren't laughing. At the end of January 2020, right. They were not laughing.
So leading up to that, right? So the short position. Now, folks, a short position is you take a short position if you feel that if your analysis tells you the company is worth way less than the stock price. So it's the inverse of a buy. When you buy something at $1, you hope it goes to $2. When you short something at $2, you hope it goes to $1. So the short sellers investors were short selling one stock, in particular GameStop, and which, once again, you couldn't write this script any better. I remember taking my 25-year-old at midnight to a GameStop 12, 15 years ago because a new game was coming out, and I thought it was the only guy. Well, there were all his friends' fathers there also. We're all looking at each other. Would you believe this? We're staying at midnight. We're driving our kids to a GameStop to buy a thing.
Yeah, Charles, I've done that too. Yeah. I've been there so many times. And the GameStop, I just was there at a book event. It was a bookstore near the local GameStop. GameStop's went out of business. It's closed. I have to drive a lot farther away now to get to one. GameStop was not a very good business today.
It was a bad business. It was a business model which time passed, and you had some professional investors who had outstanding track records, did excellent research, showing that GameStop as a viable business doesn't have any hope. The market changed. No one was buying games in a store. It was via online, and it was history. Yet, and the fundamentals of the company were just terrible. They were losing money. So now you have a stock which resonates with this young cohort, which a lot of them have great memories of, right. And you have a connection there. So you have so many factors going, and you have the stock start out, I don't know the exact date, so you fill me in on this. It's around $3 or so back when this starts, or?
Yeah, it got during the worst days of the pandemic, it got down to $2.17.
Okay, $2. So if
you was hovering around $3-4, during this time, though.
So many people, these short sellers, took positions at I remember at $10 to $14 or $15. Some was around there. Some were really fortunate to get a little higher, but I remember the $10, $15 range. I don't think any analyst on Wall Street had a buy rating on it, which doesn't say much, but it doesn't matter. But nobody could see any sunlight on this company. It was Blockbuster in 2010. It was
pretty much, yeah. That's pretty much what it was. Yeah,
it was here. So now So this young cohort, this group, this revolution starts when how do they find GameStop being so heavily shorted?
So a few different things happened. First of all, there's a guy, and I tell the story through him. So I start the story in 2019, and the way that I try to tell a story. I mean, I think 90% of people who pick the book up kind of know what happened, and so it's not like it's a surprise. But there's still a lot of suspense in the story because they didn't see the story through this guy, and this guy became central to the whole thing. His name is Keith Gill. He has a nickname, Roaring Kitty, on YouTube. That was a pseudonym. He had another pseudonym. I don't know if this is a PG or an R-rated podcast, but he had a different.
Keep PG. Keep
PG. Okay, yeah, deep effing value on Wall Street Bets. Same person. He was not unmasked until this, this was on the down slope basically. But he's an interesting guy, a very very disciplined, smart guy, chartered financial analyst. 34 years old at the time the story peaks, who decided that GameStop was a good value stock. And he just made an all or nothing bet, not even just using stock, but using options. So he basically, if he was wrong, he was going to lose all of his money on the stock. And if he was right, he was going to make a lot of money. He was making a really, really concentrated bet. And he started making posts about why he thought it was a good stock. And he was kind of laughed at. At one point, he had doubled his money and people said, great, dude, sell. He said, no, I think I wouldn't be maximizing value. And that's not the way I think. And a couple of other value investors also were kind of sniffing around. Michael Burry, who's one of the characters in Michael Lewis's The Big Short, went and bought about 5% of the company. And then people kind of noticed it and it went up for a while. And he wasn't happy. He was unhappy about it, even though he made about $50,000 on paper when this guy, Michael Burry, came in. He said, I'm not happy because now he made it more expensive for me to buy more. So that's a pretty sound way of thinking, by the way. I mean, that's the way that long-term winners think. They're not looking at what the market thinks in the short term. They're saying, this is my analysis. I want to buy it as cheaply as possible. Yeah, and then I'm going to see what happens.
If you want to buy it as cheap as possible, you don't advertise it on board. You do your accumulation pretty quietly.
That's true. That was his first post, though, to be honest. So his first post was, thanks a lot, Burry, for jacking up my cost basis. But then he had his position and then he was talking it up, and he wasn't a stock tout. I mean, he was just arguing his position, and he had a lot of valid arguments. I mean, maybe he was right, maybe he was wrong. We won't ever know because
doesn't matter, right?
Things over. The crazy market situation kind of overtook that reality.
By the way, Mrs. Lincoln, how was the play?
Totally, right. But for 90% of the story, he is ignored. And then as all these young people are rushing into the market and they're buying Tesla and they're buying Nvidia and they're buying hydrogen garbage truck startups that have a fake product, and they're buying SPACs, and they're buying bankrupt rental car companies and doubling their money, like some smart stuff, some dumb stuff. This is not the kind of thing that they're interested in. So it was a very bad year for short sellers who were betting against, kind of shiny, overvalued stocks. But GameStop pretty much went back to being in the dumps. And suddenly in the summer of 2020, you had somebody who was nicknamed the Nasdaq Whale make this maneuver. And I don't think this was very carefully analyzed by the people on the board, but a few of them did notice, who went in and bought billions and billions of dollars for their account of stock options in all kinds of stocks on NASDAQ. And it looked like a great bet because those stocks were going up. And it was like a self-fulfilling prophecy, because if you buy a lot of a certain type of stock option, then the people who sold you those options, if the stock starts to go up, they have to cover themselves. So they're open to an unlimited loss. They sold you the right to buy the stock at a higher price. But if the stock actually gets to that price and starts surging, then they're in a big trouble. The little bit of money you paid them for the option isn't going to cover the amount of money they have to spend selling you the stock at that really high price. So let me just
interject here. So for our audience, this is basically the tail wagging the dog. It doesn't work that way. It works the opposite way. So here, this guy went through totally legal, absolutely legal. You'll disclose who that was in a second, and you see how this plays out. But it was a very clever maneuver with someone who's extremely sophisticated and knew how the game was played to, I wouldn't say prop up, but to have the stocks that he wanted to go up. This is the way to do it.
That's right. Although maybe not, right? But it worked for a while.
But I remember you were reporting at the time, of course. But
yeah,
I remember everyone was looking at this, and they could easily isolate it down to a handful of people, because who could swing that kind of line in billions of dollars so quickly, and that, go ahead, disclose who it was.
And then it came at the Financial Times. My old employer unveiled who it was. It was Masayoshi Son, who's one of the richest men in the world, the CEO of SoftBank, which is a venture capital group. And he was also buying the stocks at the same time. He was buying billions of dollars in stocks. He was basically just swinging for the fences in the most aggressive way possible.
And at the time, let me just add one piece of color, because WeWorks, one of his companies that he was investing, just wasn't, the bloom was off that rose. And
so that was supposed to be worth $47 billion. It was weeks away from an initial public offering, and then the kind of emperor has no clothes moment. And his company had lost $9 billion the previous quarter, so he needed a win desperately. And for a while, it looked like this was going to be a big win. It did kind of unravel, but it did show people how you can do this. If you have enough money, and you purchase, it's called out of the money short dated call options. So the call options that cost pennies and can give you, 1,000 times your money if you got it right.
This is basically lottery tickets. With an option, you usually have, there's a certain amount of time with an option you're paying for here. And I didn't know this until I read your book, that at one point, Robinhood, these things were expiring on Friday at market close. They were giving you till like 11 or 12 o'clock to place a trade, or some. Who thought this one options.
Up? Yeah. But they were happy. It was all money for them. They don't care.
Because the odds of this winning, the odds of it, I'm sorry.
But the thing is, like, that's why you don't deal with people on Wall Street, or you're very careful at least dealing with people on Wall Street who make money on the front end. Robinhood didn't care. Robinhood sold it to these people. They make a lot of money on options. They don't charge a commission, but they make a lot of money because they sell the order.
Right.
And they had customers going in, buying options that were, I think only some people are going to sort of grasp this immediately, but I'll just tell you, it's a way of guaranteed 100% losing all your money. They would buy an option that was out of the money. So it was like a contract, like if this thing happens, and then they would exercise it right away, which showed that they had no idea what they were doing. And they were still selling options to these people. So they were selling options to people who had no business buying these sophisticated products. They had to approve them because that's what the rules say, but they were approving people who clearly were, at least some of them were not, they had no business doing this stuff.
I want to tell you something, Spencer, that in my newsletter, we have close to 100,000 paid subscribers. And I sent out an update, I think it was in early 2020. 2020. I sent it out in February, March. I said, stay away from Robinhood. If you want to open an account, open up with a reputable brokerage firm. And I didn't know all the shenanigans that were going on. I didn't know about the order flow. I didn't know how they were doing what they were doing. I did not know the detail that you put out in your book. But what I did tell them to stay away from, one reason, the gamification of investing, to me, was poison. You're now telling people that it's a game just like DraftKings or just like betting on it. Became a full contact sport. And investing that's not the right mindset one should have. Mm-hmm. And I remember I was getting emails from some of my subscribers saying, why they're democratizing investing. I said, you got to be serious, man. I was on Wall Street for a while. There is no democratization there. It's a one-way street. That's into their own pockets. It's like the casino caring for the bettor or the gambler. They don't.
Yeah. Well, to be clear, they deny it. Okay. So they deny gamifying their app. And they say the democratizing finance. So that's, that's consistently their message. We're democratizing finance. We're giving opportunity. You don't want people to have opportunity.
The confetti that used to drop.
How can you be against democratizing finance? Right? It's a strong argument.
The confetti that dropped when you made money or something, that's not gamification.
I think so. I think it's gamification. That's what they were accused of. They dropped that. I'm telling you that giving their side of the story. They deny it, and they say they didn't gamify and they're giving people opportunity. No, it's a very colorful, intuitive app. It happens to resemble some of these daily fantasy sports apps. And then some people think that that's not a coincidence at all, the way that it's designed. Certainly the way that it's designed, when you open it up, and what do you see? You see the stocks that have had the top moves. Is that an important piece of information, do you think? What should you show people? You should show people like a line chart of the Dow Jones Industrials. That's what I might see if I open up, I don't know, Fidelity, where I have my 401k. That's what they show me. Or they show me the top moving stocks, or the stocks that most people are talking about, or the stocks that most people own. Well, if you do that, then one side effect is you're giving people FOMO. Young people always want to know what other young people are doing, where they're hanging out, what video they're watching, what's viral, right? So you're kind of showing people what's viral. And it's been shown that there are a lot of quote unquote crowding events among Robinhood's customers. They will crowd into a trade on a stock. And I think the way that they display things likely plays a role in those crowding events, that they all hear about the same stocks. They hear about them on social media too, not just on Robinhood, but they open up the Robinhood app, and what the first thing you see is what's going on. And that's a big reason that people treat it more like Instagram. So their active customers would open the app about 7 times a day.
Yeah,
there's no reason to check your account 7 times a day.
What'd you put in here? The Halloween candy effect, right?
Yeah.
Free money, zero commissions. You have the Halloween candy effect. Everybody will take more. And then you had a situation where, what was the age group of the Robinhood people? It was I think 20-something years old, and the average account size was $241. Or
the median account size.
Median account size.
Yeah, but exactly. And they had a lot of young customers. I think the median customer was more like 31, so on the younger side, but definitely it skews very young. $241 was a. Can you imagine in 1985 showing up at a stockbroker and saying, "I have $241. I'd like to open up an account"? They'd be like, "You're gonna lose a fourth of your account in the first trade, and you're gonna lose another fourth of it when you sell your stock."
Mutual funds at the time. I remember mutual funds at the time. It used to be $10,000 minimums, and then I remember Dreyfus was one of the first to lower to $5,000, and I remember Dreyfus was $2,500, which was considered a bargain, but it was a $241.
Well, let me be clear, okay? So I don't think that that's a bad thing. I think that being able to interact more cheaply with Wall Street, I think being able to get on the financial ladder as a young person is not a bad thing. But you can make things too easy, right? You can take away the cost of something, and then you could put up some guardrails too.
That's like,
and there are no guardrails put up because it's a good business to bring these young people into the market.
You're saying it's like having a CPR course for alcoholics in recovery at a liquor store. Well, there's redeeming factors there. CPR. Everything was set up in order to promote I don't want to say reckless. Let me rephrase. To promote rampant speculation that was done impulsively, and all the bells and whistles were there to promote that and keep it going.
And also, when you sign up for a Robinhood account, you can get an instant account. That's the default, or you can downgrade to a cash account. What's the difference? The difference is that if you have an instant account, let's say your friends, I don't know, at college is like, dude, I've got a Robinhood account. If you open an account, I'll get a free share of stock and you'll get a free share of stock. It's a mystery stock. So it's like a lottery ticket. Okay. First of all, that's gamified, in my opinion, is getting that mystery free share of stock, because it could be a really valuable stock every once in a while. Then you open up your account. Well, hey, you know what? If you open up a Schwab or a Fidelity account right now, you can't trade right away, because you say, okay, I'm transferring money from my bank account. They still want to have the money before you can trade. But Robinhood would allow you to trade right away. They're like, okay, you're good for the money. It's coming in a few days. Why don't you trade right away? So if you had some impulsive idea, if your friend was like, dude, you should open up a Robinhood account and you should buy some GameStop or buy some Nikola or buy some Tesla, you didn't have to wait. And if you only had enough to buy a fourth of a share of Tesla, that was okay too, because you could buy a fractional share and pay zero commission. So you could do almost anything and gain exposure to almost anything without any cooling off period. And I believe that was important too. That you could be completely impulsive, going from somebody telling you about an account to filling out the stuff to actually being able to make your first trade before your money actually has reached the account through the wires of the banking system.
How much do they front you? If say I opened this account for $10,000, they wouldn't give me $10,000 of credit, would they?
I think that there are limits to that, but most of the accounts, like I said, the median account was $241. But the fact that they would front you the money, now that's not margin. Margin is a different thing, and margin has certain requirements, so they'd have to approve you for margin. Although they did provide margin to a lot of their customers, and they had something called Robinhood Gold, where you would get the first $1,000 of margin borrowing for free if you paid for Robinhood Gold, which was $5 a month. So they did get a lot of their customers to sign up for margin. They also had a unusually large percentage of their customers default on margin loans compared to other brokers.
It was a course of doing business, all the money that they were making from selling. But all right, let's move on from there. So you have this situation. Let's get back to here where the story really goes to in January. So you have this GameStop, which is a $3 stock going to zero on a quick ride to zero. Now starts getting pumped up for a whole bunch of reasons that you just mentioned. And now the frenzy starts to take place in December, right? December time or so?
Yeah, from between September and December, let's say. September is when Ryan Cohen shows up. Ryan Cohen is a very clever young guy who was the founder of Chewy.com.
Yeah, when I'm a customer. I love him.
I love him. I love him too. I'm a very loyal customer of Chewy.
We used to place orders. I used to place an order before they were bought over, but I used to place an order at 11 o'clock on, let's say, Monday, and by Tuesday at noon, I'd have 2 50-pound bags of dog food. Amazing.
Yeah, yeah. It's. I'm a very happy customer. I'm happy to pay a little bit more too, if I have to, because they're very good. He's no longer affiliated with Chewy, but he founded it, and he's a very smart businessman, and he showed up with 9.9% of GameStop, and he's a young, cyber savvy guy. He knows about retailing, and so all of a sudden the hopes really, really rose, and legitimately, right? He shows up. I mean, you're not going to buy 10% of this company for no reason. He must see something, and he knows about e-commerce, and so maybe he's going to come in and transform this company. He started agitating for change. Later on in January, he got on the board, which kicked off another frenzy in the stock, and then people discovered Keith Gill. They didn't know him as Keith Gill yet, and they saw that as back early as the summer of 2019, he was touting the stock. And he had been very right. And he kind of became a mascot of Wall Street Bets. People would constantly go back and look at his posts and see what he was saying and watch his videos. And Keith Gill, I think that he got a bit spooked because he was actually a financial advisor, technically, and was not supposed to be doing this. And so he got more quiet, where he said less things. He said fewer things explicitly and just started posting memes. I don't think that, to be clear, that he did anything wrong or illegal, but I think he was aware of his legal responsibilities. And so, he certainly didn't give away who he was or what he did for a living. And he started just, kind of getting very interested in the fact that now there was the possibility of a short squeeze, because you had these hedge funds that were extremely short. And so they were starting to lose money, and Ryan Cohen was there, and maybe Ryan Cohen was going to do something else. And so there was the possibility that they were talking about openly of a short squeeze. And then people started talking about doing a gamma squeeze, which was this thing that the Nasdaq Whale had done, Masayoshi Son, buying all these options to manipulate the price of the stock higher. Because all the options dealers would then have to, as the price rose, it would be like a virtuous cycle where they'd have to buy the stock. And they were talking about it openly. And the guys at these hedge funds should have seen the writing on the wall. They should have gotten out, and they did not. Generally, I mean, that was their chance to just go and do something else. Okay, and but they just didn't take it seriously.
They don't. And the stock starts to rise, and not rise, but actually go into the stratosphere. Walk us through that.
Starts to go up in December, and GameStop continues to report very bad numbers. So its business is going horribly.
And the stock's going up. The stock's going up.
But the stock's going up. The business is going down a lot worse than expected. The stock is going up in the opposite direction. Then in January, they reported their Christmas sales, awful. that doesn't matter anymore because Ryan Cohen shows up and he says, I'm going to be on the board, and I'm putting these two other people who were with me at Chewy.com on the board, and you people, other people who are on the board, several of you, please pack your bags and leave. And they agreed, and that just set off the storm. And then the stock was going up through mid-January. Then you had, now Gabe Plotkin of Melvin Capital was the one really losing a lot of money, and another short seller shows up who was known to the people on the board, whose name is Andrew Left. He's an activist short seller, a very brash, vocal short seller, who shows up and on Twitter on January 19th, he says, listen, you guys are the patsies at this poker game. I know all about short selling and you don't. I'm telling you why the stock is going a lot lower. And then they had a different enemy who was just, sticking it in their face. And they
had a public lynching.
They had a public lynching. They hacked his accounts. They terrorized him on social media and in person, and sent him menacing messages and did all this crazy stuff, which is horrible to do to anybody, no matter what you think of them in business, right? And he couldn't do his presentation because his social media accounts had all been hacked. And then all of a sudden they had a really identifiable enemy. They had Melvin or Gabe Plotkin and Melvin Capital. And then they had this guy who was, to them, it was a lot worse. And he had shorted some stocks that they liked on the Wall Street Bets board already, and made some money and forced them into some losses through some of his research. And so he just got bulldozed and run over. He got out with a 100% loss in these positions.
They also promised never to, they didn't promise, but he basically said, I'm not going to be public about these anymore. Was that something that he did?
Yeah, he said, I'm going to stop producing short research. And this guy had taken on some mean guys. He had taken on actual criminals. He had faced criminal prosecution at one point abroad, right? And so, and so he was, it's not like it was his first rodeo, and he was just shaken, and I spoke with him different times throughout this period, and he was uncharacteristically shaken. He's not a wimp, let's put it that way. And he was just really, he didn't know what to do and what to say. And he published a couple of videos. They're still on YouTube. The name of his company is Citron Research. If you want to watch them, very conciliatory to this group, not that they cared. And he got run over. Gabe Plotkin got run over. Gabe Plotkin's fund lost almost $7 billion in a matter of days.
Yeah, well, let's give it a little color. Gabe Plotkin was a really, really successful. He's a smart guy. He worked for Steve
Cohen.
Yes, was SAC.
SAC, yeah.
Which I forgot the new name change. What was the name now they call them?
It's 0.72 now, but it was SAC when he worked there. Yeah,
left, had him back him. Cohen backed him for a lot of money, and this was a smart guy. He knew what he was doing, and he made one year, I think, $800 million. He was doing really well. Personally, his take.
Yeah.
So when he was shorting this, and like you said, his people were not looking, or he wasn't looking at this. This was a freight train coming right at his face, and he was short. And I remember, I think the Wall Street Journal kept publishing how this guy was short, and it was costing him huge amounts of money until he had it not bailed out, but got a cash infusion.
Yeah, he said, it wasn't a bailout. So he got a cash infusion. I guess it's not a bailout. I don't know what you call
Whatever
it.
You want to call it.
Of $2.75 billion.
Right.
And the two people who contributed that cash were his old boss, Steve Cohen. Most of it came from a man named Ken Griffin, who also plays a central role in the story. Ken Griffin runs one of the biggest, most successful hedge funds in the world, but he also runs a company that's called Citadel. He also is the major shareholder in a firm called Citadel Securities, separate firm that was the main firm that processed the trades of Robinhood, that paid it for its trades. There are others, but it was the biggest source of revenue for Robinhood, buying its trades. And like it's not a stock market, it's not a bank, but it's a market maker. It's a wholesaler. It processes the trades using very sophisticated, fast computers, and then fills the trades. It's not
and pays a fee.
Like cheating or lying. That's its business, and that's what it does. And it actually gives pretty good execution and pretty good prices to these retail traders. But its business allows Robinhood's business to exist.
Right. Robinhood's business could not exist if you didn't have Citadel.
If you didn't have companies like that,
Citadel buying the order flow. right?
Right.
They
Yeah.
couldn't do that. Okay, so now the stock, and let's take us to January. The stock price goes up. I remember one day it just doubled, 100 to
Yeah.
200. So I don't. It went up to original. How high was it? 450.
$483 is where it peaked. Yeah.
400. So you took
483.
right. What was the market cap? GameStop had a market cap at the height of what? How much was that worth?
Oh gosh, I think it was worth. It went from being worth $230 million to 24 billion, right? Yeah,
Amazing.
something like that. Yeah.
Yeah.
Yeah. So it was maybe briefly even more than that, but I think its closing market value is about 24 billion. So it was worth a lot for a business that had not made money in years.
They're close
putting
to
it mildly.
close to 35 billion because now it's $102 a share. That's
well, it has more. There are more shares now.
Oh,
so
okay. So
it issued more shares.
8 billion.
So I think on a closing basis, maybe 24 was the
24
was the peak, but I could be wrong. I can look back.
Who knows?
But intraday it might have been more. It was worth a lot.
It doesn't.
483 is what it did intraday, and it was. Yeah, I mean, the business is not worth that much, obviously, but it's stock price is just it is what it is. The market's always right, and it looked like, and the hedge funds that were initially there got out with severe losses. New hedge funds came in. Then Elon Musk, the CEO of Tesla, who is revered by the same cohort, by this young Gen Z and millennial cohort, came out on Twitter to his Twitter followers with one tweet at 4:08 p.m. that Tuesday, January 26th, GameStop. Not GameStop, GameStonk, because a stonk is a company that you just goes up anyway. And that set off a new explosion. And then he had a link to Wall Street Bets. He knew exactly what it was, in case you couldn't figure out what he was talking about. And that set off a new conflagration. And then Robinhood was having a great week until it was having possibly its worst week ever, because Robinhood could not handle the volume. Because brokers have a broker. You think that something happens instantly. You look at your brokerage account and you're like, I bought the stock, money went out of my account, and the stock's in my account. Well, no, the stock's not in your account yet. And the money went out of your account, but it's going to take a couple of days to get to whoever, right? Whoever bought it, and vice versa. And you don't see that, but that plumbing of the system goes through a clearinghouse. And the clearinghouse is like the broker's broker. Just make sure everyone gets paid and gets their stock. And then if you come up short as a broker, the clearinghouse has a problem. So it wants to make sure that you have enough money on deposit so that in case you're not good for the money. And it went to Robinhood. Robinhood, was still a pretty small company. And it said, guys, you need to come up with $3 billion in the next 3 hours before the market opens. Otherwise, you're shut down. And there was no way, even today, with the kinds of money being thrown around, there was no way they could get $3 billion in 3 hours in the middle of the night. So they went back to the clearinghouse and they said, listen, if we stop our clients buying these stocks, and that's why you identified this risk, because they're buying this handful of stocks like GameStop, AMC Theaters, BlackBerry, Bed Bath & Beyond, Nokia, all these that became the meme stocks. If we stop people from buying anymore, then what do we owe you? I said, then you owe us $700 million in change. And they could just about do that. They called in all their bank lines and they did it.
Let me just point out one thing for our listeners. The reason, and correct me if I'm wrong, that the clearinghouse did it on these specific stocks is because the swings in price was so great that in order to mitigate their risk, they were asking for more money down per trade. Right?
Yeah,
so that's
exactly.
What I said.
The swings were so crazy, and so many other clients owned it because Robinhood was the main broker of all these people.
Right.
And people were opening accounts. Think about it, somebody may have opened an account on that Monday and bought the stock that day. And their money didn't even arrive until Wednesday. Amazing. Or they bought it on Wednesday and it wouldn't arrive until Friday. So the money was not there at Robinhood yet, or they were using margin borrowing, or they were doing other things. And so there was a huge amount of risk being taken by its customers, but ultimately it was Robinhood's risk because its customers might not have very much money, right?
Right.
If you're like a 24-year-old kid, that's all your money. They can't, they could come after you for more money, but you're like, dude, I don't have any money, right? So that's not good enough for the clearinghouse. Right. And so the clearinghouse, said, okay, $700 something million, that's fine if you don't allow your clients to buy any more of these stocks. And they went crazy. And they didn't explain. And think about Robinhood was in a difficult position here, right? Because you can't really signal to the market if you're a financial institution, like we're almost out of money, right? That's that's not a very smart thing to say when you have lenders and you have all kinds of counterparties. And so they came up with a very technical mumbo jumbo answer to their customers. Their customers went crazy because this was saving the hedge funds. Then the price of all these things started to go down. Within a week, GameStop lost almost 90% of its value. So this kind of, who knows how much higher it could have gone. There would have been a limit, but they kind of cut the rally short. Maybe it would have been worth $200 billion. Who knows, right? There's no rational limit to what something could be worth.
The rational limit, it had all of the makings of a disaster of enormous magnitude, could have wiped out zillions of people who were on the hook for this. Nobody really knew. So what looked like such a, it wasn't an innocent move. It was a planned move by the clearinghouse to stop this. It was a runaway train. So that broke the fever. That's when the fever broke, and I believe hedge funds who were short were able to get out somewheres around there, or were starting to get out there.
Well, it depends. When some still lost money, but they were able to get out, at a lower price. So it kind of did bail out those hedge funds, but that's not why it was done. And to this day, there are conspiracy theories. Just yesterday or 2 days ago, there's some warehouse burned down near Chicago. Like, oh, that's where they kept the records of so-and-so. See, it's all a conspiracy. I mean, it doesn't matter what happens. Like, it came out in some investigations that people from Robinhood were talking to people from Citadel Securities. Well, yeah,
it should be.
I think they were. I mean, they were the main source of revenue. I'm not surprised they were talking. I mean, they weren't saying, hey, stop trading. I mean, if Robinhood had not had this problem, they would have loved to keep on going. If Citadel Securities would have loved to keep on going because they were making a lot of money on processing all these trades. So it wasn't a bad thing for them. It was just too much of a good thing. And that's the simple reason why it stopped. But immediately people are outraged because it does look awfully suspicious, and it looked like they were bailing out the hedge funds. And so you had Ted Cruz, you had AOC, you had Donald Trump Jr.,
you heard these
you had
people
Josh
talking.
Hawley. Everyone was piling on, and late night talk show hosts were piling on, and people misunderstood what was going on, but they were raking Robinhood over the coals. And then congressional hearings were called that day for 3 weeks hence, which is.
When you heard these people talk, you realized they had no idea how the financial system works. And it was really not grandstanding, but they were just it was grandstanding. They were just getting out there, just shooting the breeze on things they had no idea. It wasn't conspiracy theories. It wasn't anything. And I just saw the other day when we're filming this, when we're broadcasting, when we're recording this, the FBI seized computers of short seller Andrew Left of Citron Research over GameStop and what happened back in January 2021.
Yeah, I mean, who knows? Maybe there is something else there that they saw. I can't say why the FBI would do that, but yeah, they were looking for bad guys, because you always want to find a bad guy, and they might not be looking in the right place. Maybe they were looking in the right place with him. Maybe there's something else going on there. I have no idea. That's above my pay grade. But they called these hearings, and they called out the short sellers that are destroying the American dream of mom and pop, which is exactly backwards, because short sellers have been kicked to the curb. And listen, the short sellers are not angels, but they exist for a reason. The absence of short sellers is bad for mom and pop, which is something that is just. I think for some politicians it's difficult to understand, and for some politicians it's not difficult to understand, but they don't want to understand it.
It's not popular. It's not popular.
It's not a popular stance. Right?
If it wasn't for the short sellers, they'd still be an Enron. They'd still be WorldCom. Right. They'd still, the short sellers are like the hyenas of the Serengeti. You need them. They're the scavengers. I wouldn't compare them all to that, but I'm just giving.
Yeah, you can call them hyenas, right. But you didn't have hyenas, you'd have a problem. You'd have a lot of bloated corpses, right?
Right. They are important for the ecosystem, because if a company is not run by a bunch of charlatans, if Apple was subject to a short raid of short sellers, who cares? It doesn't matter. They would go right through it, because they're not going out of business and they're not cheating. But the frauds that are being exposed and the charlatans who are pumping up stocks, that's the purpose of the short sellers. the short sellers can't
right. And just making prices right, because you got to have
Right.
somebody who bets against the price. You can't just have,
and we're all buying in the
you
one
can have
direction.
you can have like, I'll buy the stock or I won't buy the stock. You have to have somebody out there saying, not only will I not buy the stock, but I'm going to sell the stock because I think it's too high.
Right.
You know, you need somebody making that bet for prices to be more correct.
You need someone on the other side of that trade. If you don't have someone on the other side of the trade, you're dead. So, Spencer, there's so much that I could speak to you about for the next couple of hours on this book. It's just absolutely great. It gives you which I lived through this, and I'm in the business, and I'm reading, and I'm living through it, and I'm reading this. There were so many intricate things you brought up about the order flow, the payments, all the details that I had no idea about, which makes it even scarier, which makes they don't well, I'm not editorial. Well, I am editorializing here. If it wasn't for breaking the fever here, a lot of young people, the ones who were actually trying to go against Wall Street, would have been killed. Wall Street bailed them out. The irony of it.
Yeah, kind of. It wasn't doing them a favor either, but yeah, it did. That's the thing. They're so angry that trading was stopped, but they would have lost more.
It's like a kid sitting there eating so much sugar, and you hate your parents for it, but thank God you're going to have teeth one day because of that. and
right.
It was a thing. But it just, one final close on this. What do you think Wall Street learned from this revolution? And I use that term lightly. And what did the retail trade learn?
I think Wall Street's they're paid to learn. They learned how to arm themselves against this. They learned to take social media seriously and this young group of investors seriously. They're much better prepared. About 85% of hedge funds today have either pay for a service or have a service themselves, or they troll through social media. They read it faster than a human can read it, and they're prepared. What did retail learn? I think nothing good, because I think that this new generation, some of them learned that Wall Street's a crooked place, but they're bitter about Wall Street. So I think that hopefully some of them are going to say, like, you know what, I lost some money on this, or I made a little bit of money, but this is not really a sustainable way to invest. I have an account now. I'm going to just, buy some conservative things and hold them, and they have their foot on the ladder. I think that's going to be a small minority. I think most of them are going to say Wall Street's crooked. I'm not going to have anything to do with it. I'm going to keep my money in, NFTs or whatever.
I'm going to go to Bitcoin. I'm going to go to Bitcoin. It's fueling Bitcoin's rise.
Right. So that's a shame, because you need to engage with, you don't need to, but you should engage with Wall Street. You should invest. You should build up a nest egg. You should do it in a slow, methodical, conservative way, setbacks and all. And, and too few there's a retirement crisis in this country, and there's a retirement crisis for people who are close to retirement, but there's also a retirement crisis for people who are 40 years away from retirement, who have no plan for doing it. And so if you don't get on that ladder, then you're doing yourself a disservice. And I think that a lot of young people, I think, are going to just take such a dim view of Wall Street and see it as a place full of crooks. And of course there are crooks, unfortunately, but I mean, generally, there are good, cheap ways to invest where you pay very little money to Wall Street and engage with it very little, and you can do very well. And a lot of them are going to miss that. They're going to take a detour off of that road.
Well, that's the price of experience. That's the price they're going to have to pay. It doesn't come cheap. This is the tuition. Jack Bogle's Vanguard's out there. It beats 95% of all money managers over a 15-year period. Buying a simple index fund would cost you nothing. And, put a little money away each month, and that's it. But who wants to get rich slowly when you can get rich overnight? Unfortunately.
Well, it's a tough sell.
That's it. What's it? Just the last word on this, and I'm going to give it to you, is that, the more things change, the more they remain the same. There's nothing new here. It's really nothing new.
That's the thing. There were some new things. I mean, I hate to say it's the same old story, because there's some very unique twists to the story, and I tried to tell it in an entertaining way too. And there's definitely some unique twists. But of course, it's the same old story of Wall Street, winning and the little guy losing. And it doesn't have to be that way, because the technologies that I talk about also are of great benefit to the little guy. Yep. Like those index funds. Those index funds didn't exist 40 years ago. Right. And you couldn't invest for 0.03%. And that's the same thing that makes $0 commissions possible.
That's right. Technology brought the cost down for the average person to invest better than a institution could have 20 years ago.
Right.
It's amazing. Folks, the name of the book is The Revolution That Wasn't GameStop, Reddit, and the Fleecing of Small Investors by Heard on the Street columnist at the Wall Street Journal, Spencer Jakab. Definitely, it should be on your reading list this year because there are so many great lessons on investing that he weaves throughout the book. I'm talking as if you're a third person here, but I love all of the things about the social proof, influence, and how you build a stage because there's so many great lessons there. This is a book that you should definitely get because history doesn't repeat itself; it rhymes, and this was definitely this rhymed like so many other catastrophes that I've seen. So, Spencer, all the power to you. Fantastic. How the book is going? Went on sale on February
1st, February
1st, and so hopefully by the time you guys get this, there's a zillion 5-star ratings, and I'm sure a lot of these people are going to flame you and call you the devil incarnate. So. Have you been any attacks or anything personally against you from this book?
Oh yeah, for sure, yeah.
Wow. Wow.
Yeah, it's it is what it is. Like kind of the 1-star reviews and things like that. Some of them are just so obviously malicious that Amazon will be like, if it's something just insulting, I didn't read the book, but this guy's a clown. So they'll remove that. But yeah, it's what it is. What it is. I think people will see through that. Listen, if somebody reads this and they thought it was just okay, then leave a just okay review. Leave an honest, sincere review. If you read the book but if you loved it, then don't be shy about that either, of course, because that all matters to to an author who wants to have another book, right?
Right.
How the last book did. And so, Charles, I really appreciate the kind words about the book. I'm so glad you liked it. Thank you for having me.
Oh, great, man. All the power to you, and just keep coming out with great stuff. And I want to tell you, I was telling you on the phone when we first spoke, I've been getting the Wall Street Journal for close to 30, it's going to be 40 years. 40 years. And the beginning of next year, it'll be 40 years. May 2023, that's when I first started as a floor trader in 1983. I started getting the Wall Street Journal. I don't think there have been many days in my life that I have missed it. And the first thing I do is I turn now to the editorials in section 1, and which I'm so glad to hear is the Heard on the Street is the second thing I turn to. I think you do great stuff on the back page. Really good stuff for investors.
Thank you. Thanks. I appreciate it.
All right. Spencer, thanks so much for your time, man. I greatly appreciate it. We'll have to have you on again. Thanks for listening to this episode of The Charles Mizrahi Show. If you're a new listener, welcome. If you've been listening for a while, we're glad to have you back. Either way, we'd love to know what you think of the show. Please leave a review if you listen on Apple Podcasts. Reviews make it easier for others to find the show. You can also see the video of the interview on the Charles Mizrahi Show channel on YouTube.